Let's get this bread. Welcome to what might be the most practical accounting topic you'll learn this semester, master budgeting. And I know what you're thinking. Budgeting? That sounds boring. But let me show you something that will change your perspective completely. Every successful business you admire, whether it's NVIDIA dominating the AI chip market, Costco revolutionizing retail, or Bad Bunny building a music empire, they all master this exact process we're about to explore. This isn't just about spreadsheets and numbers. This is about vision made tangible, strategy made measurable, dreams made actionable. Whether you're watching this at 2 a.m. during finals week, on your lunch break between shifts, or replaying it before your exam, welcome. You're exactly where you need to be. What you learn in the next 75 minutes will serve you whether you become a CFO, start your own business, or manage your personal finances. By the end of this lecture, you'll understand budgeting at a level that separates good managers from exceptional ones. Not because I'm magic, but because we're building this from the ground up using your world, your language, your experiences. We're going to use examples from everything: Formula One team budget management, Rihanna's Fenty beauty production decisions, your own Spotify subscription billing, because this principle operates everywhere value flows. Price is what you pay, value is what you get. Warren Buffett understood that investing time in mastering budgeting pays dividends for decades. Let's get this bread, literally, figuratively, and financially. Some of you are already mentally checking out, thinking this doesn't apply to you. Maybe you're planning to be a software engineer, or go into marketing, or become a content creator. Let me tell you something real quick. Every single one of those paths requires budgeting mastery. That startup you want to launch, investors will demand detailed budgets before writing checks. That marketing campaign you want to run, management will ask, what's the budget and what's the ROI? That YouTube channel you're building. Understanding your revenue budget versus expense budget determines whether it's a hobby or a business. This isn't just accounting class content. This is life skill content that compounds in value every year of your career. So stay with me. The next 75 minutes will change how you see money, business, and strategic decision making forever. And let me be transparent about what you're getting into. This lecture is dense. We're covering a complete master budget with 10 interconnected schedules. You might need to pause and rewind sections. You might need to watch certain slides twice. That's not a sign you're struggling. That's a sign you're learning deeply. The students who pause, take notes, work through examples themselves, they're the ones who truly master this material. The ones who passively watch and hope it sticks. They struggle on exams. Active engagement beats passive consumption every time. So grab your notebook, open Excel if you have it, and prepare to build this budget with me. We're not spectators, we're participants. Let's go. The fundamental truth, scarcity and choice. Let's start with fundamental truth. Every resource is limited. Time is limited. Money is limited. Materials are limited. Labor is limited. This isn't pessimistic, it's reality. And because resources are limited, choices matter. Every dollar spent on one thing cannot be spent on another. Every hour allocated here cannot be allocated there. This is the economic foundation that makes budgeting not just useful, but necessary. Now here's where budgeting becomes powerful. It's the systematic process of making those choices before you're forced to make them under pressure. Think about it. Would you rather decide how to allocate resources when you have time to think, analyze, and strategize? Or when you're in crisis mode, cash is running out, and decisions must be made immediately? Pause. Let that question sink in. Master budgeting is strategic thinking made concrete. It's the bridge between we want to grow revenue by 30%, and here's exactly how we'll do it, month by month, dollar by dollar, resource by resource. This evolved because businesses needed a better tool. Companies were failing not because they lacked revenue, but because they mismanaged cash flow, overcommitted resources, and made contradictory decisions across departments. Smart leaders said there must be a better way, and master budgeting became that way. When Carnegie Steel pioneered cost accounting and budgeting in the late 1800s, it revolutionized manufacturing. They could suddenly predict costs, allocate resources strategically, and outcompete rivals who were operating blind. That competitive advantage through better planning. It's still available today to those who master budgeting. Here's what's fascinating about scarcity and choice. It operates at every level of reality. Your body has limited energy, so it chooses which organs get blood flow priority. Your phone has limited battery, so it chooses which apps can run in the background. Ecosystems have limited resources, so species compete and adapt. The universe itself operates on principles of finite energy and resource allocation. Budgeting isn't some arbitrary business practice. It's humans applying universal principles of resource optimization to organizational management. When you understand this deeply, you see budgeting everywhere. Cities budget infrastructure spending. Universities budget scholarships and faculty positions. Hospitals budget staffing and equipment. Even your Netflix account budgets how many devices can stream simultaneously. The principle is universal because scarcity is universal. Your world right now, budgeting in daily life. Here's how this works in your actual life right now, today. Your monthly budget, whether you write it down or just keep it in your head, that's budgeting. When you check your bank account before deciding whether to order Uber Eats or make ramen, you're doing cash flow analysis. When you calculate whether you can afford concert tickets and next month's rent, you're doing resource allocation across time periods. When you decide to work extra hours this week because you know textbooks are due next week, you're doing proactive planning based on anticipated expenses. But here's the elevation. What you're doing informally and reactively, businesses do formally and proactively. They're not winging it. They're not checking the account and hoping. They're engineering outcomes through systematic planning. Your DoorDash monthly spending, that's an expense budget. Your financial aid disbursement schedule, that's a cash receipts budget. Your decision between buying a car or Ubering for another semester, that's capital budgeting. The difference between you and a Fortune 500 company isn't the concept, it's the scale, sophistication, and software. The thinking, that's universal. Let me give you another example that'll hit home. Your phone's data plan. You budget gigabytes per month. When you're at 80% usage with a week left, you make choices. Stop streaming music, download playlists on Wi-Fi, use Wi-Fi only for TikTok. That's budget management. When you blow past your limit and get throttled or charged overages, that's exceeding budget with consequences. When you upgrade to unlimited because your usage consistently exceeds your plan, that's strategic budget revision based on actual performance. Every single principle. We're going to learn in corporate budgeting. You're already living in personal budgeting. The mechanics scale up, but the thinking stays the same. And here's what's powerful. Once you master budgeting in this class, you'll instantly become better at personal financial management. Students who take this course seriously consistently tell me years later, I thought I was learning corporate accounting, but I actually learned how to manage my own money, plan my career moves, evaluate job offers, and make major life decisions. That knowledge transfer, that's real, that's valuable, that's why we're here. The journey ahead, what we're building. Over the next 75 minutes, we're going to build a complete master budget from scratch for a company called Royal Company. We'll prepare 10 interconnected schedules: sales, production, materials, labor, overhead, cash, and more. Each one builds on the previous one. like levels in Valorant where you need the abilities from round 3 to clutch round 4. Some of you are feeling confident right now. You've always been good with numbers. Spreadsheets make sense to you. Some of you are already anxious. Math isn't your thing. FR, and this sounds overwhelming. Here's what I know. By slide 40, both groups will understand this deeply. The confident students will discover layers of complexity that make this intellectually engaging. The anxious students will discover that this is more logical than difficult. Once you see the pattern, it clicks. I know some of you are watching this feeling like you'll never get it. I felt that way too when I first learned budgeting. But here's the truth. Every expert was once a beginner who didn't quit. Your journey from confusion to clarity starts right now, and I'm going to walk with you every step of the way. I'm going to be real with you about what this journey looks like. Minutes 1 to 20. We're building foundations, why budgeting matters, how pieces connect. You might be thinking, when do we get to the actual budgets? Trust me, this foundation is everything. Minutes 20 to 45. We're in the numbers, calculating sales budgets, production budgets, material budgets. This is where it gets real, where you'll need to focus, where you might need to pause and rewind. Minutes 45 to 70. We're integrating everything. Cash budgets, financial statements, seeing how it all connects. This is where the aha moments happen, where it clicks, where you realize this actually makes sense. Minutes 70 to 75. We're synthesizing and empowering what this means for your career, your life, your future. Stay with me through all of it. The journey is worth it. And here's my promise to you. I'm not going to leave anyone behind. If you're struggling with a concept, I'm going to explain it multiple ways, using different examples until it connects. If you're bored because you already get it, I'm going to show you deeper layers that challenge you. Everyone in this virtual classroom, whether you're watching live or months from now, you all matter. You're all capable. You're all going to succeed. That's not motivational fluff. That's my genuine belief based on teaching this for years. Let's do this together. Why organizations budget. The 5 levels of why. Why do organizations budget? First answer, the practical why, to plan revenues and expenses for the coming period. Second answer, the strategic why, to coordinate activities across departments so everyone works toward the same goals. Third answer, the business why, to control spending and ensure resources aren't wasted. But let's go deeper, because understanding the why behind the why transforms budgeting from a chore into a strategic weapon. Fourth answer, the economic why, because uncertainty exists and planning reduces risk by creating clarity about resource needs before shortages occur. When you know you'll need $500,000 in June, you arrange financing in April. When you discover that in June, it's too late. Fifth answer, the philosophical why, because humans seek to maximize outcomes with finite inputs, and conscious planning beats reactive scrambling every single time. This isn't just business wisdom. This is universal truth about how to navigate a world of constraints and choices. Budgeting isn't arbitrary bureaucracy. It's inevitable given fundamental truth about scarcity and choice. Think about NVIDIA's rise to a $3 trillion market cap. You think Jensen Huang just winged it? No cap. Their budget planning for chip production, R&D investment, and fab capacity allocation positioned them perfectly for the AI boom. They made strategic choices years before ChatGPT launched, allocating billions to areas others ignored. That's the power of disciplined budgeting. When organizations don't budget, they drift. When they do budget, they navigate with purpose. And here's something most people miss. Budgeting forces honest conversations that organizations would otherwise avoid. When you budget, you can't hide from reality. You can't say, we'll figure it out, or it'll work itself out. You have to make actual decisions. Do we have enough cash to fund this expansion? Can we afford to hire 10 new people? Should we invest in new equipment or repair old equipment? These conversations are uncomfortable, but they're necessary. Organizations that avoid budgeting are avoiding these hard conversations, which means they're avoiding reality. And reality always wins eventually. Better to face it proactively through budgeting than reactively through crisis. Planning perspective, forward-looking vision. From a planning perspective, budgets force organizations to think ahead, not just react to whatever happens. Imagine you're managing a Sweet Green location. Without a budget, you order ingredients based on yesterday's sales, hire staff based on who shows up, and hope for the best. With a budget, you analyze seasonal patterns, summer salad rush, winter soup demand, plan employee schedules around anticipated volume, coordinate with suppliers for bulk purchasing discounts, and allocate marketing spend to drive traffic during slow periods. See the difference? One approach is reactive and chaotic. The other is proactive and strategic. The budget becomes your roadmap. Here's where we're going. Here's how we'll get there. Here's what we need along the way. It facilitates communication across teams. The sales team knows what revenue they need to generate. The production team knows what output they need to achieve. The finance team knows what cash they need to maintain. Everyone's rowing in the same direction. When Netflix budgets for content spending, $17 billion annually, they're planning based on subscriber forecasts, engagement data, retention analysis, competitive intelligence, and content performance metrics. They're not guessing. They're synthesizing information into decisions about resource allocation. For first-generation college students in here, you know how your family plans for major expenses like quinceañeras, weddings, or holiday gatherings. That multi-month planning, saving, coordinating. That's budgeting applied to life events. Same principle, different context. Planning creates alignment, and alignment creates results. Here's what's powerful about planning. It creates optionality. When you plan ahead, you have options. Need to hire 5 new people? With planning, you can recruit thoughtfully, interview carefully, choose the best candidates. Without planning, you're hiring desperately, taking whoever's available, hoping they work out. Need to purchase equipment? With planning, you can research options, negotiate prices, time the purchase strategically. Without planning, you're buying whatever you can get immediately at whatever price. Planning creates breathing room that enables better decisions. Reactive management eliminates options and forces compromises. That's why the best organizations are the best planners. They create options for themselves that competitors lack. Control perspective, performance measurement. Budgets aren't just planning tools, they're control mechanisms. Control isn't about being controlling, it's about maintaining control. Once you create a budget, you can compare actual results against budgeted amounts. This reveals performance. Are we hitting our targets? Where are we exceeding expectations? Where are we falling short? At Home Depot, every store manager has a budget. Monthly, they compare actual sales, labor costs, and expenses to budgeted amounts. Beat your budget? That's bonus territory, potential promotion, recognition as a high performer. Miss your budget consistently? Time for coaching, investigation, maybe reassignment. This isn't about punishment, it's about information. Variances, differences between budgeted and actual. Tell you where to dig deeper, investigate, adjust. Maybe sales are below budget because a competitor opened nearby. That's strategic information. Maybe labor costs are above budget because you're overstaffed for actual volume. That's operational information requiring adjustment. Think about your meal plan. You budgeted $300 a month for food. You're spending $450. The $150 variance isn't just a number. It's information. Why the difference? Too much delivery? More expensive restaurants? Sharing meals with friends? The variance sparks investigation, and investigation leads to better decisions. The budget becomes your baseline for evaluating reality. Control also provides accountability in a healthy way. When everyone knows what the targets are and what the current performance is, you create transparency. People can't hide behind excuses or vague explanations. The numbers tell the story. This accountability drives performance because people rise to clear expectations. Research in psychology shows that measured performance improves over time. What gets measured gets managed. What gets managed gets improved. But here's the key. The measurement has to be fair, the targets have to be realistic, and the consequences have to be balanced. Punitive control systems that only punish failure create fear and gaming. Developmental control systems that celebrate success and coach through failure create excellence and growth. The difference isn't in having budgets, it's in how you use them. Integration of planning and control, the cycle. When planning and control work together, you create a continuous improvement cycle. You plan, create budget, execute, operate the business, control, compare actual to budget, learn, analyze variances, adjust, improve next budget. Repeat. It's a cycle, a rhythm, a flow. This isn't a one-time event. It's an ongoing process of planning, executing, learning, and improving. Formula One teams exemplify this perfectly. They budget for the season, R&D spending, personnel costs, travel, parts, testing. During the season, they track actual spending and performance weekly. Exceed budget on aero development, but it's generating wins. May be worth it. Over budget on parts because of crashes. Need better driver coaching or car reliability. The budget provides the framework for these strategic conversations. Working students in here, you're living this right now. You budget your time between work, school, family, sleep. When finals hit and you're working 30 hours plus taking exams, you're over your time budget, running a deficit on sleep. That variance tells you something needs to adjust. Maybe reduce hours temporarily, maybe drop a class, maybe improve efficiency. The budget helped you identify the problem. Organizations that budget well don't just survive, they compound advantages over time through better decisions, better resource allocation, better strategic positioning. The beautiful thing about this cycle is that it's self-correcting over time. Your first budget might be wildly inaccurate. Estimates are off, assumptions are wrong, unforeseen issues arise. That's okay. You compare actual to budget, learn from variances, and your second budget is better. Third budget is even better. Fifth budget is highly accurate because you've learned your patterns, understood your business, refined your assumptions. This is why experienced managers create better budgets than new managers. They've been through the cycle multiple times and learned from each iteration. You're building capability through repetition and reflection. Defining a budget. Every word matters. A budget is a detailed quantitative plan for acquiring and using financial and other resources over a specified time period. Let's break that down word by word because every word matters. Detailed, not vague goals like increase sales, but specific. Sell 50,000 units at $10 each for $500,000 revenue. Quantitative, expressed in numbers, dollars, units, hours, measurable and objective, not feelings or hopes. Plan, created in advance before the period begins. So you're proactive, not reactive. Acquiring and using, both sides of the equation, where money comes from and where it goes. Financial and other resources, cash, yes, but also materials, labor, equipment, time, everything scarce. Specified time period, usually 1 fiscal year, though we'll see variations. This isn't a wish list or a forecast based on trends. It's a commitment, a target, a standard against which performance will be measured. When Adobe budgets for Creative Cloud subscriptions, they're not guessing. They're planning based on renewal rates, churn analysis, marketing spend, new feature rollouts, competitive dynamics. Every number has a story, a rationale, supporting logic. Understanding what a budget truly is, a detailed quantitative plan, helps you appreciate its power and precision. The word commitment is critical here. A budget isn't a hope or a wish, it's a promise. When you submit a budget and it's approved, you're making a commitment to the organization. I will deliver these results using these resources. That commitment has consequences, professional consequences, financial consequences, career consequences. This is why budget creation should be taken seriously, not treated as a bureaucratic box to check. Your reputation as a professional will be shaped significantly by whether you deliver on your budget commitments. The managers who consistently hit or exceed budget, they get promoted, trusted with bigger responsibilities, given more resources. The managers who consistently miss budget, they get scrutinized, micromanaged, eventually replaced. Budgets aren't optional or theoretical. They're professional commitments with real stakes. Budget time periods, annual plans, and variations. Most organizations budget for one fiscal year, 12 months of planned operations. But here's where it gets interesting. How you structure that year varies. Some companies do a traditional static annual budget, January 1st to December 31st. Create it in November, live with it all year. Others divide the year into quarters, Q1, Q2, Q3, Q4, with more detailed monthly budgets for the nearest quarter and broader estimates for distant quarters. Then there's the sophisticated approach, continuous or rolling budgets. These are perpetual plans that constantly look 12 months ahead. How it works: every month or quarter that passes, you add a new month or quarter to the end, maintaining a rolling 12-month budget window. It's like your Spotify Discover weekly playlist, constantly updating, always fresh, perpetually reflecting current reality. Microsoft uses rolling forecasts. As Q1 ends, they add Q1 of next year to their budget, always maintaining a 4-quarter forward view. This prevents the problem where by December, you're executing a budget created a year earlier based on outdated assumptions. For students working retail, you know how Target adjusts staffing for back-to-school season, then holiday rush, then January lull. That's quarterly budget planning matching their business rhythm. They don't staff December the same as February. That would be wasteful and illogical. The choice of budget period isn't just technical, it's strategic. Annual budgets work well for stable, predictable businesses. Quarterly updates work for moderately dynamic businesses. Rolling budgets work for rapidly changing businesses. But here's the tension. Shorter budget periods and more frequent updates require more management time and effort. There's a trade-off between accuracy and efficiency. A monthly rolling budget is maximally responsive to changing conditions, but requires significant time investment in planning. An annual static budget is efficient to create, but risks becoming obsolete. Organizations choose their approach based on their industry dynamics, competitive environment, and management philosophy. Tech startups in rapidly evolving markets, rolling monthly budgets, utilities with stable demand and costs, annual budgets are fine. Choosing the budget period, matching your rhythm. The time period you choose for budgeting isn't arbitrary. It should match your business rhythm and decision-making cycle. Operating budgets typically cover one fiscal year because that matches tax reporting, performance evaluation cycles, and strategic planning horizons. But different industries need different approaches. Fashion retail like Zara operates on season-based budgets. Spring, summer, and fall winter collections drive everything, so their budgets align with those 6-month cycles. Construction companies budget project by project plus annual overhead because a 3-year stadium build needs long-term budgeting while corporate overhead is annual. Tech startups burning VC capital often budget monthly with quarterly reviews. They need tight control because runway is limited and burn rate determines survival. Think about your academic calendar. You don't budget your semester by calendar year, January to December. You budget by academic terms, fall and spring, or quarters. Your expenses spike in August/January when tuition and books hit. They're moderate during the semester. They're minimal during breaks. Budgeting January to December would miss your actual spending rhythm. The principle, match your budget period to your business's or life's natural rhythm. There's also psychological research on budget periods that's fascinating. Studies show that people tend to spend more freely early in a budget period and tighten up toward the end. It's called the fresh start effect. Beginning of the month, you're loose with spending. End of the month when the budget is depleted, you're cautious. Organizations experience this too. Q1 spending tends to be aggressive. Q4 spending tightens up if the annual budget is stressed. Knowing this pattern, smart managers smooth spending across periods rather than front-loading or back-loading. They resist the psychological biases that lead to uneven resource allocation. This self-awareness about behavioral tendencies makes you a better budget manager. Continuous budgets, always forward-looking. Continuous or rolling budgets represent evolved thinking about planning. Instead of creating a budget once per year and watching it age, you maintain a perpetual 12-month forward view. As January ends, you drop January from the budget and add next January. As Q1 concludes, drop Q1 and add Q1 of next year. Always 12 months ahead, always current, always relevant. This solves a critical problem. By November, your annual budget reflects assumptions from last October, over a year old. Market conditions change, competitors move, customer preferences shift, costs fluctuate. Operating on stale assumptions degrades decision quality. Intel adopted rolling forecasts after experiencing this pain in the semiconductor industry, where demand and technology shift rapidly. Their static annual budgets were obsolete within quarters. Rolling budgets keep planning fresh. Here's the student life parallel. Imagine planning your entire college career as a freshman. I'll take these specific classes in this exact order for 4 years. By junior year, that plan is probably outdated. You've changed majors, discovered new interests, faced different prerequisites than expected. Better approach. Always maintain a 2-year forward view, adjusting as you go. That's rolling planning applied to education. The downside? More work. Continuous planning requires more management time than annual planning. But the upside? Better decisions based on current reality. The rolling budget also changes organizational behavior in subtle but important ways. With annual budgets, there's a temptation to use it or lose it. If your department has budget remaining in November, you spend it all because next year's budget might be based on this year's spending. With rolling budgets, that gaming behavior reduces because there's always a next period to consider. The artificial end-of-year deadline that drives wasteful spending disappears. Instead, spending decisions are made based on ongoing need rather than arbitrary fiscal year boundaries. This leads to more rational resource allocation and less political budget games. Companies that switch from annual to rolling budgets consistently report reduced gaming behavior and more strategic decision-making. Participative budgeting, the power of involvement. Organizations combine top-down and bottom-up approaches to budgeting, but the most effective method involves self-imposed or participative budgets. This means managers at all levels participate in creating the budget rather than having it dictated from above. When a store manager helps create their own store's budget, when a department head contributes to departmental targets, when production supervisors input realistic manufacturing estimates, that's participative budgeting. and it's powerful for multiple reasons. First, it shows respect for lower-level managers' judgment and expertise. They're closer to the actual operations. They know the realities on the ground. Their input matters. Second, it produces more accurate estimates because the people doing the work understand the work better than distant executives. Third, it increases motivation and commitment. People support what they help create. Starbucks empowers store managers to participate in budgeting. They input local market knowledge, seasonal patterns they observe, staffing needs based on traffic flow. That local knowledge makes budgets more realistic and managers more committed to achieving them. For parents going back to school, you know about participative planning. Your family budget works best when everyone participates. Spouse, older kids, everyone contributes input about needs and priorities. When you dictate the budget without input, family members resist. When they help create it, they support it. There's also an element of fairness and justice here that matters enormously for organizational culture. When budgets are imposed top-down without input, employees perceive it as arbitrary and unfair. They don't understand our situation. They're setting us up to fail. They don't value our expertise. This creates resentment and disengagement. But when budgets are created participatively with genuine consideration of local input, employees perceive it as fair and reasonable. We had a voice, our concerns were heard, the targets are challenging but achievable. This perception of fairness dramatically affects motivation and morale. Organizations with participative budgeting consistently show higher employee satisfaction, lower turnover, and better performance. The psychology matters as much as the math. Budgetary slack and management review. Self-imposed budgets create accountability in a healthy way. If you told your boss, I can hit 50,000 units this quarter, and you helped build the budget around that number, you're committed. You made the promise. You own the target. Compare that to your boss saying, corporate says you must hit 50,000 units. You didn't commit. Someone else did, so you feel less ownership. However, pure bottom-up budgeting has a risk, budgetary slack. That's when managers intentionally create easy targets, understating revenue estimates or overstating expense needs to make achievement easier. So higher management reviews budgets, provides broad guidelines like profit targets or sales growth minimums, and ensures budgets are challenging but achievable. Netflix's culture of freedom and responsibility applies to budgeting. Teams have significant autonomy in budget creation, but also high accountability for results. They're trusted to budget realistically, and they're held accountable for achieving what they budget. That creates healthy tension between participation and accountability. For those of you entering management, you'll live this tension. You'll be asked to create budgets for your area, and you'll feel pressure to make them achievable. The temptation to pad is real, but integrity matters. Budget what's truly realistic, commit to challenging targets that drive growth, and execute with excellence. The way organizations detect budgetary slack is interesting. They look for patterns and anomalies. If your department consistently exceeds budget by 20%, that suggests your budget has slack. If you requested a 30% increase in expenses with only 10% revenue growth, that triggers questions. Sophisticated organizations use analytics to identify departments that habitually sandbag their budgets, and they adjust the review process accordingly. Some companies implement zero-based budgeting, where every expense must be justified from scratch each year, rather than assuming last year's budget as a baseline. This eliminates inherited slack that accumulates over years. The cat and mouse game between managers trying to create slack and executives trying to eliminate it has spawned entire consulting practices and software platforms. It's a real organizational challenge. The Master Budget Overview: 10 interconnected pieces. The master budget is a comprehensive financial plan integrating all aspects of an organization's operations. Think of it as the ultimate synthesis, every department, every function, every resource, all coordinated into one cohesive plan. It consists of multiple interconnected schedules that build on each other like a financial puzzle, where each piece depends on previous pieces. The major components include sales budget showing expected unit sales and revenue, production budget showing how many units to manufacture, direct materials, budget showing raw material needs and purchases, direct labor budget showing labor hours and costs, manufacturing overhead budget showing overhead application, selling and administrative expense, budget showing period costs, cash budget showing all cash inflows and outflows, budgeted income statement showing projected profitability, and budgeted balance sheet showing projected financial position, 10 schedules, 10 interconnected decisions, 1 comprehensive plan. Here's the flow. You can't know production needs without knowing sales targets. You can't know material purchases without knowing production requirements. You can't budget cash without knowing when you'll collect from customers and pay suppliers. Everything connects, everything depends, everything integrates. It's like building a house. You need the foundation before walls, walls before roof, roof before interior. The sequence matters. When you see all 10 schedules laid out, the master budget looks intimidating. But here's the secret. You build it one piece at a time, in sequence, and each piece is logical and manageable. Nobody creates the entire master budget simultaneously. That would be impossible. You create the sales budget first, then production, then materials. Each schedule takes maybe 10 to 15 minutes once you understand the logic. The whole master budget might take a few hours to build, but it's broken into digestible chunks. That's why we're walking through this step by step, rather than throwing the entire thing at you at once. Complexity becomes manageable through sequential breakdown. This is true in budgeting and in life. Overwhelming challenges become achievable through systematic step-by-step approach. The 10 key questions. What the master budget answers. The master budget answers 10 fundamental questions that every business must address. Question 1. How much revenue will we generate? That's the sales budget. Question 2. When will we collect cash from customers? That's the schedule of expected cash collections, because revenue and cash aren't the same thing. Question 3. How many units must we produce? That's the production budget, balancing sales needs with inventory targets. Question 4. How much raw material must we purchase? That's the direct materials budget. Question 5. When will we pay for materials? That's the schedule of expected cash disbursements for materials. Question 6. What are our manufacturing costs? That's combining direct materials, direct labor, and manufacturing overhead budgets into total production cost. Question 7. What is our cost of goods sold? That's linking production cost to units sold through the ending finished goods inventory budget. Question 8. What are our operating expenses? That's the selling and administrative expense budget. Question 9. Will we have enough cash or do we need to borrow? That's the cash budget, the most critical schedule because you can be profitable and still go bankrupt from cash shortage. Question 10. What will our financial statements look like? That's the budgeted income statement and balance sheet. These 10 questions build on each other. You can't answer question 5 without answering question 4. You can't answer question 9 without answering questions 1 through 8. The sequence is logical, necessary, inevitable. The power of framing budgeting as questions rather than schedules is that it makes the purpose clear. You're not filling out forms for bureaucratic reasons. You're answering critical business questions that determine success or failure. When you frame it this way, budgeting becomes meaningful rather than mechanical. Every schedule exists to answer a question that matters. The sales budget isn't busy work. It answers, how much revenue will we generate, which determines everything else. The cash budget isn't optional. It answers, will we survive financially, which is literally existential. Understanding the purpose behind each schedule motivates better work and deeper thinking. You're not just plugging numbers, you're making strategic decisions disguised as financial calculations. Integrated budgeting with Excel, the power of scenarios. When you use Excel for budgeting, and most companies do, you create an assumptions tab where you input key variables, sales growth rate, collection percentages, inventory policies, labor rates, overhead rates. Then each budget schedule links to those assumptions and to previous schedules. Change one assumption, say, increase expected sales by 10%, and Excel automatically recalculates every downstream schedule. Production increases, materials increase, labor increases, cash needs increase, everything cascades. That's the power of integrated budgeting through technology. You can run what-if scenarios instantly. What if sales are 20% higher? What if material costs increase 15%? What if we delay equipment purchases? The master budget becomes a strategic decision tool, not just a planning document. When Walmart's CEO considers opening 100 new stores, the FP&A team builds budget models showing capital requirements, revenue ramps, profitability timelines, cash flow impacts, ROI projections, all using master budget logic. The decision, should we expand, becomes answerable through modeling rather than guessing. For students learning budgeting, building this in Excel yourself is invaluable. Don't just read the textbook answers, actually create the schedules with formulas linking each budget to the next. That hands-on building is where learning happens. Excel is the minimum standard. Every finance professional must be Excel proficient. But enterprise companies use specialized software that goes beyond Excel. Anaplan, Adaptive Insights, Workday Adaptive Planning, Oracle Hyperion. These platforms handle complex multidimensional budgets across thousands of cost centers, integrate with ERP systems for actual data, manage workflow approvals, track versions and revisions, enable scenario planning at scale. Large companies might have 500 people contributing to the annual budget through these systems. The skills you're learning, understanding budget logic, building interconnected schedules, running scenarios, those transfer directly to enterprise platforms. The interface changes, but the thinking remains constant. Whether you're using Excel, Google Sheets, or million-dollar enterprise software, you're applying the same master budget principles we're covering today. Introducing Royal Company, our budgeting example. For the rest of this lecture, we're going to prepare a complete master budget for Royal Company, a manufacturing company. We're budgeting for the quarter ending June 30th. Screenshot this slide because these assumptions drive everything. Budgeted unit sales, April 20,000 units, May 50,000 units, June 30,000 units, July 25,000 units, August 15,000 units. Why do we care about July and August when we're budgeting through June? Because our inventory policies look forward. We need to know next month's sales to plan this month's ending inventory. Selling price is $10 per unit. Straightforward, no price changes. All sales are on account, meaning credit sales. We collect 70% of each month's sales in the month of sale and 30% in the following month. March's sales were 30,000 units, leaving $30,000 in accounts receivable that we'll collect in April. Starting cash balance on April 1st is $40,000. For production and inventory, desired ending finished goods. Inventory equals 20% of next month's sales. Beginning inventory on March 31st is 4,000 units. For direct materials, each unit requires 5 pounds of material at 40 cents per pound. Desired ending materials inventory equals 10% of next month's production needs. Beginning materials inventory is 13,000 pounds. We pay 50% of material purchases in the month of purchase and 50% in the following month. March's material purchases totaled $24,000, creating $12,000 in accounts payable. Take a moment to breathe here. I know that's a lot of numbers flying at you. This is realistic business complexity. Real budgets involve this many assumptions and more. The key is organizing the information systematically rather than trying to hold it all in your head simultaneously. When you're working through budget problems, write down the assumptions in organized lists. Group related information together, sales assumptions, inventory policies, payment terms, etc. This external organization compensates for limited working memory and prevents errors. Professional budget analysts keep detailed assumption sheets that document every number's source and rationale. When assumptions change, they update the sheet, and the budgets recalculate automatically. That discipline of documentation is what separates amateurs from professionals. Continuing with Royal Company's assumptions. For labor, each unit requires 0.05 hours of direct labor, that's 3 minutes per unit, at $10 per hour. For manufacturing overhead, we apply overhead based on direct labor hours at $20 per direct labor hour variable rate, plus $50,000 per month in fixed overhead, which includes $20,000 of depreciation that's non-cash. For selling and administrative expenses, variable S&A is 50 cents per unit sold, and fixed S&A is $70,000 per month, including $10,000 of depreciation. We have a line of credit at 16% annual interest, can borrow up to $75,000, must maintain minimum cash of $30,000, borrow on the first day of the month, repay on the last day. We're paying a $49,000 dividend in April and purchasing equipment for $143,700 in May and $48,300 in June. Deep breath. That's a lot of information, but every number has a purpose, and we'll use each one as we build the budget. This is realistic complexity. Real budgets involve this many assumptions and more. Now let's start building. Notice the level of specificity here. We're not saying we might borrow some money or overhead is roughly covered. Every detail is quantified. Interest rate is exactly 16%. Minimum cash is exactly $30,000. Equipment costs are specified to the dollar. This precision is essential for budgeting accuracy. Vague assumptions produce vague budgets that aren't useful for decision making. Professional budgets document every assumption with supporting rationale. Why is the interest rate 16%? Because that's our current line of credit terms from the bank. Why minimum cash of $30,000? Because that's our historical average of daily cash needs for operations. Every number has a story. When someone questions a budget assumption, you should be able to explain where it came from and why it's reasonable. This accountability for assumptions is what makes budgets credible and useful. Sales budget, the foundation of everything. The sales budget is the foundation of the entire master budget because sales drive production, production drives material and labor needs, and everything drives cash requirements. Without knowing how much you expect to sell, you can't plan anything else intelligently. So we start here, always. For Royal Company, we're budgeting sales for April, May, and June, the second quarter. April budgeted unit sales, 20,000 units times $10 per unit equals $200,000 revenue. May budgeted sales, 50,000 units times $10 equals $500,000 revenue. June budgeted sales, 30,000 units times $10 equals $300,000 revenue. Total budgeted sales for the quarter, 100,000 units generating $1 million in revenue. Clean, straightforward math. But here's what's not straightforward. Revenue doesn't equal cash. This is crucial, one of the biggest mistakes in financial understanding. Royal Company sells on account. meaning customers buy now and pay later. That creates a timing difference between recording the sale and collecting the cash. So we need a second schedule of expected cash collections. This shows when we'll actually receive cash from sales. The distinction between revenue and cash is where many businesses fail. They look at their income statement, see profitability, and assume they're financially healthy. Then they run out of cash and can't make payroll despite being profitable. This happens constantly with growing businesses. They're selling more and more, growing revenue, but they're collecting cash slower than they're spending it on inventory and operations. Revenue growth actually drains cash in the short term before generating cash in the long term. Understanding this timing difference is critical for survival. That's why the cash collection schedule isn't optional or secondary. It's essential for understanding financial reality. You can survive being unprofitable temporarily if you have cash. You cannot survive running out of cash even if you're profitable. Cash is more important than profit for short-term survival, period. Schedule of expected cash collections, timing matters. Remember our collection pattern, 70% in the month of sale, 30% the following month. Let's work through April. We collect 70% of April's $200,000 sales in April. That's $140,000. We also collect the remaining 30% from March's sales. That was $30,000 in accounts receivable from the beginning balance sheet. Total April collections, $140,000 plus $30,000 equals $170,000. Now May. We collect 70% of May's $500,000 sales. That's $350,000. Plus we collect the remaining 30% from April's $200,000 sales. That's $60,000. Total May collections, $350,000 plus $60,000 equals $410,000. Finally, June. We collect 70% of June's $300,000 sales. That's $210,000. Plus 30% from May's $500,000 sales. That's $150,000. Total June collections. $210,000 plus $150,000 equals $360,000. Total cash collections for the quarter, $170,000 plus $410,000 plus $360,000 equals $940,000. Notice something. We had $1 million in sales, but only $940,000 in collections. The $60,000 difference, that's June's uncollected 30% that we'll collect in July. Your Venmo pending requests work exactly like this. Someone owes you money, you'll get it, but you don't have it yet. That's accounts receivable. This is also why businesses obsess about days sales outstanding, how long it takes on average to collect payment. If Royal Company could improve their collection from 70-30 split to 80-20 split, they'd collect $940,000 plus $30,000 equals $970,000 instead of $940,000. That's $30,000 more cash available for operations just from faster collection. Companies employ entire collections departments focused on accelerating customer payments. They offer early payment discounts. Pay within 10 days and get 2% off, because having cash faster is worth the discount. They closely monitor aging reports showing which customers are paying slowly. For Royal Company operating on thin margins, improving cash collections by even a few days could eliminate the need for borrowing, saving interest expense. This is why AR management is a critical finance function that directly impacts cash flow and profitability. Production budget. Manufacturing what we need. Now that we know sales targets, we can determine production needs. The production budget answers, how many units must we manufacture? The answer isn't simply how many we expect to sell, because we also need to maintain inventory. The production budget formula is fundamental. Required production equals budgeted sales plus desired ending inventory minus beginning inventory. Let's apply this to Royal Company for April. Budgeted sales, 20,000 units. Desired ending inventory, we want to end April with 20% of May's sales as inventory. May sales are 50,000 units, so 20% equals 10,000 units. Beginning inventory, we start April with 4,000 units left over from March. So April production, 20,000 sales plus 10,000 desired ending minus 4,000 beginning equals 26,000 units to produce. Now May. Budgeted sales, 50,000 units. Desired ending inventory, 20% of June's 30,000 unit sales equals 6,000 units. Beginning inventory, 10,000 units. That's April's ending becoming May's beginning. May production, 50,000 plus 6,000 minus 10,000 equals 46,000 units. Notice production is actually less than sales in May because we're drawing down inventory. Finally, June. Sales, 30,000 units. Desired ending, 20% of July's 25,000 sales equals 5,000 units. Beginning, 6,000 units from May's ending. June production, 30,000 plus 5,000 minus 6,000 equals 29,000 units. Total production for the quarter, 26,000 plus 46,000 plus 29,000 equals 101,000 units. The production budget formula is beautifully logical once you understand it. You need enough units to satisfy sales demand. That's the first term. You also need enough to hit your ending inventory target. That's the second term. But you don't start from zero. You have beginning inventory already on hand. That's the subtraction. Think of it like planning how much food to cook for a party. You need enough for the guests, sales, plus leftovers for tomorrow, ending inventory. But you already have leftovers from yesterday, beginning inventory, so you don't need to cook as much. Same exact logic. When students struggle with the production budget, it's usually because they're memorizing the formula without understanding the logic. Once the logic clicks, the formula becomes obvious and unforgettable. We're producing 101,000 units to support 100,000 units of sales because we're building inventory, starting the quarter with 4,000 units, ending with 5,000 units, net increase of 1,000 units. This buffer inventory is strategic. You never want to run out of product when customers want to buy. Think about PlayStation 5 shortages during the pandemic. Sony's production budget didn't account for the demand surge. They couldn't make enough units. Customers frustrated. Sales lost to Xbox. That's failed production budgeting with real consequences. Lululemon manages this carefully. They budget production to maintain optimal inventory levels in stores, enough variety for customers, but not so much they need to mark down excessively. The production budget is where strategy meets operations. Too little production means stockouts and lost sales. Too much production means excess inventory, storage costs, obsolescence risk, and cash tied up. Getting it right requires understanding demand patterns, seasonality, lead times, and capacity constraints. This is why the 20% inventory policy matters. It's a strategic choice balancing customer service against inventory investment. There's also the question of production smoothing versus chase strategy. Royal Company's production varies dramatically. 26,000 in April, 46,000 in May, 29,000 in June. That variation creates challenges: hiring and laying off workers, variable capacity utilization, inconsistent supplier orders. An alternative approach is production smoothing. Produce roughly 33,667 units each month, 101,000 divided by 3, using inventory to buffer the difference between production and sales. This creates more stable operations, but higher average inventory levels. Companies choose based on their cost structure. If hiring/firing is expensive and production setup costs are high. Smooth production. If inventory carrying costs are high and production is flexible, chase demand with variable production. Royal Company appears to be chasing demand, accepting production volatility to minimize inventory. That's a strategic choice with trade-offs, not a universal right answer. The production budget tells us how many units to manufacture. The direct materials budget tells us how much raw material to purchase to support that production. For Royal Company, each unit requires 5 pounds of material. So materials needed for production equals units to produce times 5 pounds per unit. April production is 26,000 units. So we need 130,000 pounds of material for production. May production of 46,000 units requires 230,000 pounds. June production of 29,000 units requires 145,000 pounds. But just like we maintain finished goods inventory, we also maintain raw materials inventory. We don't want to run out of materials mid-production. Royal Company's policy: maintain ending materials inventory equal to 10% of next month's production needs. So April's desired ending materials inventory equals 10% of May's 230,000 pound requirement, which is 23,000 pounds. We start April with 13,000 pounds for March. Therefore, materials to purchase in April, 130,000 pounds needed for production, plus 23,000 desired ending, minus 13,000 beginning equals 140,000 pounds to purchase. At 40 cents per pound, that's $56,000. The logic here parallels the production budget. Needed for production plus desired ending minus beginning equals purchases. It's the same structure applied to materials instead of finished goods. This consistency in budgeting logic is beautiful. Once you master the logic structure, you can apply it to different contexts. It's not 10 different formulas to memorize, it's one logic pattern applied 10 different ways. This is why understanding beats memorization. Students who understand the logic can derive the formulas themselves when needed. Students who memorize without understanding forget the formulas under pressure and can't reconstruct them. Deep understanding is what we're building here, not superficial memorization. Let's do May. Production needs 230,000 pounds. Desired ending, 10% of June's 145,000 pounds equals 14,500 pounds. Beginning inventory, 23,000 pounds from April's ending. Materials to purchase, 230,000 plus 14,500 minus 23,000 equals 221,500 pounds times 40 cents equals $88,600. And June, production needs 145,000 pounds. Desired ending, 10% of July's production. We need to calculate July's production first. July sales are 25,000 units. Desired ending inventory is 20% of August's 15,000 sales, which is 3,000 units. Beginning inventory is June's ending of 5,000 units. July production, 25,000 plus 3,000 minus 5,000 equals 23,000 units times 5 pounds equals 115,000 pounds needed. So June's desired ending materials inventory is 10% of 115,000, which is 11,500 pounds. Beginning 14,500 for May. June purchases 145,000 plus 11,500 minus 14,500 equals 142,000 pounds times 40 cents equals $56,800. Total materials purchases for the quarter, 56,000 plus 88,600 plus 56,800 equals $201,400. That's a lot of material, a lot of cash tied up in inventory. When lithium prices spiked 400% in 2022, Tesla's material budget exploded. That's why this matters. Material budgeting becomes significantly more complex in real manufacturing because most products don't use just one material. They use dozens or hundreds of components. A car manufacturer budgets steel, aluminum, plastic, glass, rubber, electronics, fabrics, paints, each with different suppliers, lead times, price volatility, and inventory policies. The budget might have separate schedules for each major material category. Boeing's materials budget for a 787 Dreamliner involves thousands of components from hundreds of suppliers across dozens of countries. Coordinating that supply chain through budgeting is extraordinarily complex. Supply chain disruptions, like the semiconductor shortage that crippled auto production in 2021, demonstrate what happens when material budgets don't account for supply constraints. Companies couldn't get chips, couldn't finish cars, lost billions in revenue. The materials budget isn't just about cost. It's about supply assurance, strategic sourcing, and risk management. Schedule of cash disbursements for materials, payment timing. Purchasing materials and paying for materials are different events with different timing, just like sales and collections. Royal Company's payment terms: 50% paid in the month of purchase, 50% paid the following month. This creates payables, amounts owed to suppliers. April disbursements. We pay 50% of April's $56,000 purchases. That's $28,000. Plus, we pay the remaining 50% for March's purchases. That was $12,000 in accounts payable on the beginning balance sheet. Total April payments, $28,000 plus $12,000 equals $40,000. May disbursements, 50% of May's $88,600 purchases equals $44,300 plus 50% of April's $56,000 equals $28,000. Total May payments, $44,300 plus $28,000 equals $72,300. June disbursements, 50% of June's $56,800 equals $28,400 plus 50% of May's $88,600 equals $44,300. Total June payments, $28,400 plus $44,300 equals $72,700. Total cash disbursements for materials for the quarter, $40,000 plus $72,300 plus $72,700 equals $185,000. Notice we purchased $201,400 of materials, but only paid $185,000. The difference is June's unpaid half, $28,400, that becomes accounts payable on June 30th, paid in July. Your credit card works identically. Payment terms are a critical negotiation point between buyers and suppliers. Suppliers prefer payment immediately or even in advance. It improves their cash flow and reduces their risk. Buyers prefer payment delayed. It improves their cash flow and provides free financing. The terms reflect negotiating power and relationship dynamics. Large retailers like Walmart leverage their size to negotiate 60 or 90-day payment terms, essentially using supplier financing to fund operations. Small businesses often have to pay cash on delivery or 30% upfront because they lack negotiating leverage. Royal Company's 50-50 split over 30 days is moderate, not particularly favorable or unfavorable. If they could negotiate 0 to 100, nothing up front, everything in 30 days, they'd improve cash flow by $16,400 in this quarter alone. That's financing without interest expense, which is extraordinarily valuable for cash-constrained businesses. Direct labor is the hands-on work converting materials into finished products. The workers on the assembly line, the production staff actually making units. Royal Company requires 0.05 hours of direct labor per unit. That's 3 minutes per unit at $10 per hour. The direct labor budget is straightforward. Units to produce times hours per unit equals total hours required, then total hours times hourly rate equals total direct labor cost. April production 26,000 units times 0.05 hours equals 1,300 direct labor hours, times $10 equals $13,000 direct labor cost. May production, 46,000 units times 0.05 equals 2,300 hours, times $10 equals $23,000. June production, 29,000 units times 0.05 equals 1,450 hours, times $10 equals $14,500. Total direct labor for the quarter, 1,300 plus 2,300 plus 1,450 equals 5,050. Direct labor hours costing 13,000 plus 23,000 plus 14,500 equals $50,500. We're assuming we pay direct labor as incurred, no payables, no timing differences. Employees work in April, they get paid in April. For those of you who've worked hourly jobs, you know about labor budgeting from the employee side. Your manager controls hours based on budget. When business is slow, hours get cut. When it's busy, hours increase. You're experiencing the direct labor budget's human impact. Labor budgeting is where ethical considerations become very real. Companies face pressure to minimize labor costs to maximize profits. This can lead to understaffing, excessive workloads, unsafe working conditions, wage theft, misclassification of employees as contractors to avoid benefits, all in service of making the labor budget look better. The ethical finance professional balances cost control with human dignity and legal compliance. Yes, labor is often the largest controllable expense, and reducing it improves profitability. But people aren't just costs. They're humans with families, needs, and rights. The labor budget should reflect fair compensation, safe staffing levels, and sustainable workloads. When companies budget labor so tightly that employees burn out, quality suffers, turnover spikes, and long-term performance degrades. Penny wise, pound foolish. The best companies budget labor generously enough to attract and retain excellent people, knowing that the incremental labor cost is offset by higher productivity, quality, and innovation. Manufacturing overhead budget. Factory costs. Manufacturing overhead includes all production costs except direct materials and direct labor, factory rent, utilities, equipment depreciation, indirect labor like supervisors, supplies, maintenance. These costs support production but can't be traced directly to specific units. We apply overhead to production using a predetermined rate based on direct labor hours. Royal Company applies overhead at $20 variable per direct labor hour, plus $50,000 per month in fixed overhead. April, 1,300 direct labor hours times $20 variable rate equals $26,000 variable overhead, plus $50,000 fixed equals $76,000 total overhead. May, 2,300 hours times 20 equals 46,000 variable plus 50,000 fixed equals 96,000 total. June, 1,450 hours times 20 equals 29,000 variable plus 50,000 fixed equals 79,000 total. Total manufacturing overhead for the quarter, 76,000 plus 96,000 plus 79,000 equals $251,000. But not all overhead requires cash. Depreciation is a non-cash expense. Royal Company has $20,000 per month of depreciation included in that $50,000 fixed overhead. So cash disbursements for overhead equal total overhead minus depreciation. The distinction between variable and fixed overhead is critical for understanding cost behavior. Variable overhead increases with production volume. More units means more electricity for machines, more supplies consumed, more wear on equipment. Fixed overhead doesn't change with volume in the short term. Factory rent is the same whether you produce 1,000 or 100,000 units. This creates interesting dynamics. At low production volumes, fixed overhead per unit is high. because you're spreading fixed costs over few units. At high volumes, fixed overhead per unit drops because you're spreading the same fixed costs over many units. This is why manufacturers seek volume. It improves per unit economics through better fixed cost absorption. Royal Company's overhead includes $150,000 fixed for the quarter spread over 101,000 units, so fixed overhead is $1.49 per unit. If they produced 200,000 units instead, fixed overhead would be only 75 cents per unit. That's significant margin improvement from volume leverage. Cash disbursements for overhead. April cash overhead is $76,000 minus $20,000 depreciation equals $56,000. May, $96,000 minus $20,000 equals $76,000. June, $79,000 minus $20,000 equals $59,000. Total cash disbursements for overhead, $56,000 plus $76,000 plus $59,000 equals $191,000. This distinction between overhead cost and overhead cash payment is crucial for the cash budget. If we forgot to subtract depreciation, we'd overstate cash needs by $60,000 for the quarter, a potentially fatal error in cash planning. Understanding this separation of economic costs from cash costs is fundamental to financial management. Boeing's overhead budget is incredibly complex. Massive fixed costs for factory facilities, variable costs for tooling and supplies, stepped costs when production volume requires additional shifts or facility space. Getting overhead budgeting wrong means misunderstanding your cost structure, which means mispricing products, which leads to unprofitability. For those interested in cost accounting, overhead application is where theory meets practice. Depreciation is one of the most misunderstood concepts in accounting. It's an expense on the income statement, reducing reported profit, but it's not a cash outflow. The cash was spent when the asset was purchased, and depreciation is just allocating that historical cost over the asset's useful life. This is why profitable companies can have negative cash flow if they're investing heavily in capital assets. The depreciation shows up as expense, but the actual cash spending on equipment is much larger. Conversely, cash-strapped companies can look profitable if they're not investing in new equipment. Depreciation is low because they're not buying assets, even though they're starving the business of needed capital. The cash budget cuts through this confusion by showing actual cash movements separate from accounting allocations. That's why both the income statement and cash budget are essential. They show different dimensions of financial reality. Ending finished goods inventory budget. Unit cost. We know how many units we'll produce in ending inventory levels, but we need to know the value of that ending inventory for the budgeted balance sheet and for calculating cost of goods sold. The ending finished goods inventory budget determines the cost per unit by combining direct materials, direct labor, and manufacturing overhead costs. Let's calculate unit product cost. Direct materials, 5 pounds per unit times 40 cents per pound equals $2 per unit. Direct labor, 0.05 hours per unit times $10 per hour equals 50 cents per unit. Manufacturing overhead, we apply overhead based on direct labor hours. Variable overhead is $20 per DL. H times 0.05 hours equals $1 per unit. Fixed overhead per unit, total quarterly fixed of $150,000 divided by 101,000 units. Produced equals approximately 1.49 per unit. Total overhead per unit, 1.00 variable plus 1.49 fixed equals 2.49. Unit cost, 2.00 materials plus 0.50 labor plus 2.49 overhead equals 4.99, round to $5. Ending finished goods inventory value, 5,000 units times $5 equals $25,000 on the June 30th balance sheet. Cost of goods sold, 100,000 units sold times $5 equals $500,000 on the income statement. Unit product cost is one of the most important numbers in manufacturing because it drives so many decisions. Pricing decisions. You must sell above your unit cost or lose money. Profitability analysis. Comparing revenue per unit to cost per unit reveals margin. Make or buy decisions. If suppliers can provide components below your unit cost, consider outsourcing. Capital investment decisions. Will new equipment reduce unit cost enough to justify the investment? Inventory valuation. What's the value of inventory on the balance sheet? Make sure you understand every component of unit cost and how it's calculated. This is foundational knowledge for anyone in manufacturing, operations, or finance. When I interview candidates for finance roles, I often ask them to calculate unit product cost from raw data. It instantly reveals whether they understand cost accounting or just memorize formulas. Selling and administrative expense budget. Period costs. Not all costs are manufacturing costs. Selling and administrative expenses, period costs, support the business overall but aren't part of product manufacturing. These include sales salaries, advertising, office expenses, executive compensation, administrative overhead. Royal Company has both variable and fixed S&A expenses. Variable S&A is 50 cents per unit sold. Fixed S&A is $70,000 per month, including $10,000 of depreciation. Total S&A expense. April sells 20,000 units times 50 cents equals 10,000 variable plus 70,000. Fixed equals 80,000 total S&A. May sells 50,000 units times 50 cents equals 25,000 variable plus 70,000 fixed equals 95,000 total. June sells 30,000 units times 50 cents equals 15,000 variable plus 70,000 fixed equals 85,000 total. Total S&A expense for the quarter. 80,000 plus 95,000 plus 85,000 equals $260,000. For cash disbursements, we subtract depreciation. April, 80,000 minus 10,000 equals 70,000. May, 95,000 minus 10,000 equals 85,000. June, 85,000 minus 10,000 equals 75,000. Total cash disbursements for S&A, $230,000. The distinction between product costs and period costs matters for several reasons. Product costs, materials, labor, overhead, get attached to inventory as an asset, then flow to cost of goods sold when units sell. Period costs, S&A expenses, hit the income statement immediately regardless of whether units sell. This creates different financial statement timing. If Royal Company manufactured 101,000 units but only sold 90,000, the product cost for those unsold 11,000 units would stay on the balance sheet as inventory, but S&A expenses would hit the income statement in full even though not all units sold. This distinction affects profitability measurement and inventory valuation. Understanding it is essential for reading financial statements correctly and making sound business decisions. Cash budget structure, the 4 sections. Now we integrate everything into the cash budget, arguably the most important schedule in the entire master budget. Why? Because you can be profitable on paper and still go bankrupt from cash shortage. Cash is oxygen for business. Run out, and you die. The cash budget has 4 sections: cash receipts showing all sources of cash inflow, cash disbursements showing all uses of cash outflow, cash excess or deficiency, comparing receipts to disbursements and showing net position, and financing showing borrowing or repayments needed to maintain minimum cash balance. Let's build this step by step. Beginning cash balance April 1st, $40,000. Collections from customers in April, $170,000 from our sales schedule. Total cash available in April, $40,000 plus $170,000 equals $210,000. Now we need to calculate all the ways we spend cash in April. The cash budget is where everything comes together. All those separate schedules we built, sales collections, materials payments, labor, overhead, S&A, they all feed into the cash budget to show total cash position. This integration is why we had to build the other schedules first in sequence. You can't complete the cash budget without knowing all the inputs. The cash budget is the culmination, the synthesis, the final answer to the question, will we survive financially? This is why CFOs obsess about cash budgets more than any other schedule. You can fudge earnings through accounting choices. You can make income statements look better through timing tricks. But cash is objective reality. You either have it or you don't. The cash budget strips away accounting complexity and shows the fundamental question, can we pay our bills? April cash disbursements. Direct materials $40,000 from the materials payment schedule. Direct labor $13,000. Manufacturing overhead $56,000 cash payment. Selling and administrative $70,000 cash payment. Equipment purchase none in April. Dividends $49,000. We're paying a dividend in April. Total April disbursements $40,000 plus $13,000 plus $56,000 plus $70,000 plus $49,000 equals $228,000. Excess or deficiency $210,000 available minus $228,000 disbursements equals negative $18,000, a cash deficiency. We're short $18,000, but we need to maintain minimum cash of $30,000, so we're actually short $48,000. The deficiency of $18,000 plus the $30,000 minimum we must maintain. We need to borrow. The company has a $75,000 line of credit at 16% annual interest. We borrow $50,000 to cover the shortage and give us a cushion. This brings our ending April cash to approximately $32,000 before interest. Working parents managing household budgets, you know about cash deficits. When expenses exceed income in a month, you either borrow, use savings, or delay payments. Businesses face the same reality. The cash budget identifies these shortages in advance. The dividend payment is interesting. Royal Company is choosing to pay $49,000 to shareholders even though they're cash short and need to borrow. This might seem irrational, but there are strategic reasons companies maintain dividends even during tight cash periods. Cutting dividends sends negative signals to investors about company health and prospects. Public companies that cut dividends often see stock prices drop significantly. So companies maintain dividends to preserve investor confidence, even if it means borrowing. The alternative, cutting dividends to preserve cash, might save $49,000 but could trigger a stock sell-off, costing millions in market value. These are the trade-offs CFOs navigate constantly. For Royal Company, borrowing $50,000 at 16% interest cost $2,000 for the quarter. That's cheaper than the potential stock price impact of cutting dividends, so they choose to borrow and maintain the payout. May beginning cash, April's ending of $32,000. Cash receipts, $410,000 from collections. Total available, $442,000. Disbursements, materials $72,300, labor $23,000, overhead $76,000, S&A $85,000, equipment purchase $143,700. This is a big one. Total May disbursements $400,000, excess or deficiency $442,000 minus $400,000 equals $42,000 excess. We're in good shape in May. We have excess cash above our $30,000 minimum. Should we repay some of the loan? We could, but let's see June's position first before deciding. Cash management requires looking ahead, not just at the current month. The equipment purchase of $143,700 is significant. This is capital expenditure for long-term assets. Notice it hits the cash budget but doesn't immediately hit the income statement. Only the depreciation will appear on the income statement over time. This is another example of economic transactions versus cash transactions differing in timing and amount. May's strong cash position, despite the large equipment purchase, demonstrates the power of collections timing. May's sales are $500,000, the highest of the quarter, and 70% of that collects immediately. That $350,000 in May collections, plus $60,000 from April's remaining collections, provides $410,000 of cash inflow. This surge in collections combined with moderate operating expenses creates the cash surplus. This is also why companies sometimes time capital purchases to coincide with high collection months. If you know cash will be strong, that's the time to make major purchases rather than borrowing. Strategic timing of capital expenditures based on the cash budget is a form of self-financing that reduces borrowing costs. June beginning cash, approximately $42,000 from May. Collections, $360,000. Available, $402,000. Disbursements, materials $72,700, labor $14,500, overhead $59,000, S&A $75,000, equipment purchase $48,300, total June disbursements $269,500, excess or deficiency $402,000 minus $269,500 equals $132,500 excess. Strong position. We can repay the entire $50,000 loan and still have plenty of cash. We borrowed $50,000 on April 1st, and we're repaying on June 30th. That's 3 months. Interest calculation, $50,000 times 16% annually times 12 months equals $2,000 interest expense. Final June ending cash, $132,500 excess minus $50,000 loan repayment minus $2,000 interest equals $80,500 ending cash balance. That's a healthy cash position, well above our $30,000 minimum requirement. The cash budget shows we had a temporary cash shortage in April, financed it appropriately, and recovered by June to repay the loan. This is exactly how businesses manage cash flow cycles. The $80,500 ending cash balance is substantial, over 2.5 times the minimum requirement. Some might say this is excess cash that could be invested elsewhere or returned to shareholders. Others would say it's prudent buffer for unexpected issues. The right cash balance depends on business volatility, access to credit, and risk tolerance. Conservative CFOs maintain higher cash balances for security. Aggressive CFOs minimize cash balances to maximize returns on capital deployed elsewhere. Royal Company appears moderately conservative. They maintain a cushion above minimums, but not excessively so. This reflects a balanced approach to cash management that prioritizes both security and efficiency. After completing all operating budgets in the cash budget, we prepare pro forma financial statements. The budgeted income statement shows projected profitability for the quarter. Sales revenue, $1 million from the sales budget. Cost of goods sold, $500,000. Gross margin, $1 million minus $500,000 equals $500,000, which is a 50% gross margin. That's healthy. Selling and administrative expenses, $260,000 from the S&A budget. Operating income before interest, $500,000 gross margin minus $260,000 S&A equals $240,000. Interest expense, $2,000 from the financing section of the cash budget. Net income, $240,000 minus $2,000 equals $238,000 for the quarter. That's a 23.8% net profit margin. Very strong. Here's the critical insight. The income statement shows profitability, but the cash budget showed cash challenges. We had to borrow in April despite budgeting for profitability. Why? Timing differences. We pay for inventory before selling it. We pay expenses when incurred, but collect from customers later, We're buying equipment which doesn't hit the income statement immediately. This is why both budgets matter. The 50% gross margin is impressive and worth analyzing. It means for every dollar of sales, 50 cents covers product costs, and 50 cents is available for operating expenses and profit. This high gross margin gives Royal Company significant operating leverage. If they can control S&A expenses, they generate substantial profit. Companies with low gross margins need to be much more careful about operating expenses because there's little cushion. The 23.8% net margin, after all expenses, is also strong, indicating efficient operations. For comparison, many retail businesses operate on 3 to 5% net margins. Manufacturers typically run 8 to 12%. Royal Company at 23.8% is outperforming. This suggests either strong pricing power, excellent cost control, or favorable industry dynamics. Understanding these margin relationships is fundamental to financial analysis. The budgeted balance sheet shows projected assets, liabilities, and equity as of June 30th. Cash, $80,500 from the cash budget. Accounts receivable, June sales of $300,000 times 30% uncollected equals $90,000. Raw materials inventory, 11,500 pounds times 40 cents equals $4,600. Finished goods inventory, 5,000 units times $5 equals $25,000. Total inventory, 29,600. Total current assets, 200,100. Land, 50,000 unchanged. Equipment beginning 175,000 plus purchases of 143,700 plus 48,300 equals 367,000. Accumulated depreciation, 90,000 for the quarter, increases accumulated depreciation. Net equipment depends on beginning accumulated depreciation. Total assets equal current assets plus long-term assets. Liabilities, accounts, payable 28,400 from materials schedule. Notes, payable, 0 because we repaid the loan. Shareholders' equity, common stock unchanged. Retained earnings increases by net income minus dividends. The balance sheet must balance. Total assets equal total liabilities plus equity. This is your self-check that all calculations are correct. The budgeted balance sheet reveals the financial transformation resulting from the quarter's operations. We started with 40,000 cash and ended with 80,500, doubled our cash position. We started with accounts receivable from March and ended with AR from June, a normal rollover. We increased inventory slightly, from 4,000 to 5,000 finished units as planned. We invested heavily in equipment, 192,000 total, increasing capacity for future production. On the liability side, we started with payables from March and ended with payables from June, normal operations. We borrowed temporarily in April and repaid by June, successful short-term financing, and retained earnings grew by 189,000. Net income of 238,000 minus dividends of 49,000 building equity. This balance sheet tells a story of successful execution, generated profit, invested in capacity, maintained healthy liquidity, managed liabilities appropriately. That's a successful quarter. While we focused on manufacturing budgeting, different business types require different approaches. Merchandising companies, retailers, don't have production budgets because they buy finished goods. Their master budget replaces production, materials, labor, and overhead with a simpler merchandise purchases budget. Service companies have no inventory of goods. They sell time and expertise. A consulting firm's budget focuses on billable hours, professional staff capacity, utilization rates. They budget salary costs, overhead for office space, but there's no COGS in the traditional sense. Software companies operating SaaS models budget subscription revenue, customer acquisition costs, churn rates, development expense. Their budgeting looks quite different from manufacturing. Healthcare providers budget based on patient volumes, reimbursement rates, staffing costs, medical supplies, compliance overhead. The fundamental budget logic applies universally. Forecast revenue, plan resource needs, budget costs, project cash flow. But the specifics vary by business model. Understanding your business model determines how you apply budgeting principles. The principles we've learned are universal, but the application is contextual. Whether you're budgeting for a law firm, a restaurant, a software startup, or a manufacturing plant, you're asking the same fundamental questions. What revenue will we generate? What will it cost to generate that revenue? When will cash come in and go out? What financial position will we be in at period end? The mechanics differ. Lawyers budget billable hours. Restaurants budget table turns and food costs. Software companies budget ARR and burn rate. But the logic structure is identical. This is why mastering budgeting fundamentals is so valuable. The skills transfer across any industry or business type you enter. Learn the logic once, apply it everywhere. Budgets don't just affect numbers, they affect people, behavior, and culture. Well-designed budgets motivate high performance by setting challenging but achievable targets. Research shows people perform best with specific, difficult goals rather than vague, do-your-best goals. However, budgets set too high demotivate. If targets are perceived as impossible, people give up. When compensation links to budget achievement, budgets become high stakes and behavior changes. People game the system, manipulating timing of sales recognition, deferring expenses, creating budgetary slack. Some companies mitigate this through balanced scorecards that evaluate multiple metrics beyond just budget variances. The CEO and CFO's approach to budgets shapes culture profoundly. Do they treat budget misses as failures requiring blame, or as learning opportunities requiring investigation? The former creates fear and gaming. The latter creates transparency and improvement. For those entering management, how you use budgets with your team matters enormously. Use them as collaborative planning tools, not as punishment justifications. There's fascinating psychological research on budget setting difficulty. The Yerkes-Dodson law suggests that performance increases with challenge up to a point, then decreases when challenge becomes overwhelming. The sweet spot for budget targets is in the stretch zone, difficult enough to require focused effort, but achievable with strong performance. Too easy and people coast. Too hard and people give up. Getting this calibration right requires understanding your team's capabilities, market conditions, and historical performance. It's as much art as science. Experienced managers develop intuition about appropriate stretch levels for their teams. New managers often set targets too aggressively, causing burnout, or too conservatively, leaving performance on the table. Learning to calibrate budget difficulty appropriately is a critical management skill developed through experience and feedback. Mastery in your future. We've built a complete master budget from scratch across 10 interconnected schedules, seeing how everything connects and integrates. You now understand budgeting at a level that many professionals never achieve because we built understanding from first principles, connected concepts to your world, and explored strategic dimensions beyond technical mechanics. Here's what you need to carry forward. Budgeting is strategic planning made quantitative. Cash is king. Profitability matters, but cash flow determines survival. Timing differences between economic transactions and cash flows create complexity you must manage. Build budgets in Excel with linked formulas allowing scenario analysis. Participate in budget creation. Involvement creates ownership. Ownership drives commitment. Build slack-free budgets. Challenging targets motivate excellence. Use budgets developmentally. not punitively. Maintain ethical integrity in all budget activities. Your homework: work the Royal Company example yourself in Excel. Don't just read solutions. Build the schedules with formulas linking each piece. When you change assumptions and watch everything update automatically, the integration clicks in ways reading never achieves. That's where learning happens. Success is walking from failure to failure with no loss of enthusiasm. Churchill knew that mastery requires persistence. You've persisted through 90 minutes of complexity and emerged with genuine understanding. Your accounting journey parallels every successful business story, starting from zero, building deliberately, compounding consistently, achieving mastery incrementally. You're on that path right now. Trust your process, honor your pace, embrace your growth. What you've learned about budgeting goes beyond accounting. It's applicable to life. Budget your time, your money, your energy. Conscious planning beats reactive scrambling in all domains. You now have knowledge that gives you competitive advantage. What you do with it is your story to write, your future to create, your success to manifest. Make it count. Make it real. Make it yours. You got this. For real. Thank you for your engagement and commitment to learning. Now go build that Excel model and cement your understanding. Let's get this bread.